Hello trade pros and welcome back to another video from Trade Pro Academy. My name is George Papazov. Today we're going to talk about the stop loss order. Many traders get stopped out only to see the position turn around and go back in their favor. And while this can be frustrating, it can be fixed. Did you know that you may actually be using the stop loss order the wrong way? After coaching over 100,000 traders, I can personally tell you that there is a way to make a difference and to change things around. It isn't the stop loss order that's responsible, it may be how you're using it. That's what we're going to look at in today's video. I'll explain to you the common mistake that's made and how to use it the correct way. So let's dive right into this video. But before we begin, please hit the like button and subscribe to our channel, and be sure to click the notifications bell to receive alerts when we have new content. We release a new video every single day. Let's jump right into this and get started. So let's first start out in this video by talking about how most people set stop losses at the moment. So here's a typical trader looking to get into a position and set their stop loss. So say, hey, I want to enter here. Say this is a market that's bullish at the moment. It's pulling back. I want to enter here at this price. And, I know that I have to manage risk. So my entry is going to be at this point. I'm risking 2% of my account. That means it's a $200 risk. Therefore, my stop should be about 7 ticks in the futures or $1 in the stock, whatever it is. And you put your stop here. And then what ends up happening is you get stopped out and it explodes higher. And you say to yourself, not again. What the heck is going on? That's one way traders and most common put stops. Another way that's extremely common and even worse than that way is you look at a stock and you've automatically predetermined your brackets. A bracket means here's your entry. You have a fixed stop loss of a point on the S&P 500 futures or $2 on your stock, whatever it is, let's call it X. So you're risking X per trade, and you have your take profit, which is a little bit higher because you have to have a bigger reward for the risk you're taking. If you want to be profitable, 2 to 1 gives you a 50% win rate. And you say to yourself, all right, this is why. So I've set these values. So you click the trade and you get in because you want to buy it now. And you have a predetermined stop loss and take profit. Now, this looks great, but it's completely irrelevant from what the market is thinking. This is just your brain thought or brainstorm process automated into a bracket order and just puked on top of the market to enter a position, but it completely ignores the context of the market. So how do you put the stop losses the right way? Most traders put their stop where they want to get stopped out, but not where the stop would be if the probabilities change on them. So I had a recent tweet that some people enjoyed that I'll read out to you verbatim, because I think this is a very helpful situation. All right. I said, trading tip. If you're getting stopped out and it goes your way, it isn't your stop, it's your entry. A stop loss isn't to limit your loss to what you want. It's to limit your loss to where the probability flips against you. Put the limit where your stop loss is and put the stop loss where it needs to go. Now, that's just a quick tip. You don't have to do that. But where the stop loss for most traders is the last thought process, they've decided already they want to get in. All right. And so now the stop loss is something that's just automated and not really thought about. But the way you need to get into trades for the stop loss to work effectively is what we call lead with the stop. All right. We know that successful traders are good risk managers. We also know that the whole industry of trading and any profit that you make is a reward for how effectively you're managing risk. You don't have to be right. You don't have to know where the market's going. You just have to manage risk. And it's simple to hear that, but it takes years for a lot of traders to truly understand the depths of that. So lead with the stop is just one example of how professionals are risk managers and earn a return by using a defense strategy of managing their capital. So here's how you actually have to do it. Okay, and I'm going to pull out a calculator for this. So you have an account. Let's say it's a $10,000 trading account. All right. And you decide to use a 2% risk per trade on any one of these positions. So what's 10,000 times 2%? I don't have to use a calculator for that. you can. It's $200. You can check my math. All right. So what you're saying is I'm going to risk $200 per trade. And this technique, by the way, is predominantly for the new trader, because once you trade enough to get consistent, you're going to come up with your own methodology. But this is a good starting point for leading with your stop and respecting the risk side of the equation. All right, so we have $200. All right, so what do we do? Let's say we want to buy the 73. Let's go to a real chart here. It's time to take it to the chart. These are the S&P 500 futures. Let's say you want to buy it for whatever reason. You're saying, hey, you know what? I really like this area right here. I like the 59. I think it's going to go up. I'm going to buy the 59 half. And so you're automatically risk $200 because your stop is predetermined. 57 is your stop because you're only using 3 points. Okay, well, guess what? You come down, you get stopped up, you're still above the support, and then it rips in your direction. So the way you need to do it is start by calculating your RPT, risk per trade. Risk per trade is $200. So the next question is, where does the stop need to be for me to say, all right, the probabilities changed from being long, I am wrong? Where do you ultimately have to take the loss because the probability of your trade has changed to the extent that you no longer should be into it? And in this example, all right, it is below the 54 because this is the support below the 54 half. If you really plan to hold this for a longer period of time, you got to grab that prior low. And if you look at some other charting, you know, these 50s are actually a huge support. There's many reasons to believe if we stay above the 50, we're going to go up. All right. There's also reason to believe if we stay above the 54 half, we're going to go up. Doesn't matter what you believe in your strategy is, as long as the stop is below a key level. All right. The stop can't end up being arbitrary. It has to be below a key level. So 54 half is a key level. All right. This is the overnight low in the market. So what we're going to do here then is calculate our stop. So we're going to be entering at the 60. All right. That's going to be our entry. Let me go on sim just to make sure that when I do this example, I actually get in because I don't want this trade. It's an afternoon. I don't want to trade anymore. But we're going to be getting in around the 60. Let's see what we could do. So the stop would have to be 53.75. So what is 60 minus 53.75? Sorry, I did it wrong. 60 minus 53.75. It's 6.25 points. Okay. How much is the risk per point on the S&P 500 futures? It's $50 a point. So if you multiply that by 50, all right, this trade you can't take. You can't even put a one lot position on because where the stop needs to be is automatically more than you would need to put on a one contract position. Okay, so then ask yourself this. If my stop was at 53.75, okay, how much risk can I take? And if you take your $200 risk per trade, your RPT, and you divide it by $50, that's 4 points. So really, if your stop has to be at 53.75 because this is determined by market price, the stop needs to be there not because you think it needs to be there, it's because the market is telling you this is where support is. So you're protected. It's called a protective stop for a reason. It's protecting your position. So in order to get that protection with 1 point, all right, with one stop, 53.75, in order to get that protection, the maximum that you could buy it up is 4 points higher from 53.75, which puts you at 57.75. All right, that's your entry because that's how much you're allowed to risk. If you want to buy more contracts, either wait for a pullback closer to the support so you could have a lower stop amount and you could load up the size, or put more money in your account. It's really that simple. And you'll say, well, you know, I can't, you need a really big account to trade the position size that I'm trading. Yeah, exactly. You do. Most of the days, people are over leveraged in futures and anything because they're just chasing gains and not thinking about risk. These risk parameters are here to protect you. So that's how you use your stop. You pick a stop where it needs to go. You lead with the stop. This is where I'm going to get out because if we get down here, a lot of low structures are broken and the market's likely going to go down. If this is where I need to get stopped, how much can I afford to buy? And you put your limit there, all right? Because the more important side of your equation is your stop loss. It is not actually your entry. And I've proven this to people in our workshops where I've let them get into the trade and I'll get out of it oftentimes with a very small loss to a profit. And on a net basis, no matter where people get in, I can work the trade out most of the time for a profit. And that proves to you, you should try this exercise too, that it's not really about the entry, it's about the exit that makes you a good trader. The exit is risk management. The entry is just optimism and hope. All right. And this is why I had another really gold moment in our trading room today. I told traders, trust the level. So if this is your level and you have it on your chart, trust it. Trust your level. Trust your analysis, but work the trade. What does that mean? Working the trade means that you're malleable. It could change a little bit. Here or there. Might get in, get back in. I might scratch it. The trade isn't fixed. The level is. What most people do instead is they trust their trades. They get in. They're like, this trade has to work, and completely ignore the level. So you really need to write this down, is trust your level and analysis and work the trade. Don't trust your trade and work the level or analysis. All right, that's a recipe for disaster. So when you combine these two things, trusting your level, working the trade, and then leading with your stop in mind in your positions, you really give yourself the edge, the advantage of only being stopped out when the probabilities go against you. Because guess what? If you eat a stop and then the market reverses back in your direction, but you shouldn't have been stopped out because the market's above support, you're just going to buy it at the top and then you're going to get stopped on the way down. Then you're going to say, I knew I should have bought it lower. Now I'm going to buy it lower. Then you get stopped. Then it bounces and you're going to be constantly chasing the market because you're getting stopped out when you shouldn't be getting stopped out. You're getting stopped out when you should, in fact, still be working the long trade. By putting the stop where it needs to go, most of the times that you get stopped out, it'll end up being one of those things where you say, thank God I got stopped. All right. I love stops because every time, well, not every time, nothing's perfect. Most of the time they trigger, I was wrong and it protected me. Yeah, some of the times it'll take me out and it goes up. But because I use protective stops below key levels and above key levels, depending on the position type, I love it when my stop is hit because it's giving me the protection I was looking for to begin with. All right. You'll learn to love stops when you start using them the right way. So I hope this was helpful to you. You learned a ton. In a long position, start with your levels. All right. And they have to be key levels. This was just an example for this trade. In all honesty, if I was to trade this, I would be shorting, and it's always all honesty with you guys, I'd be shorting these tops. We weren't up there, so I couldn't give you an example. All right, short the tops around 70 to 73, and stop loss has to be above the open at this point. You can see every time it goes up, the short trade opens up. Goes up, the short trade opens up. So this is the level I'd be working and trusting. And right now, I'd be looking to take profit rather than looking to buy this because it's counter trend. You're going against the momentum. But I wanted to demonstrate with you while it was close to price, so the math example worked out good. That's what I got. Now you've learned how to lead with your stop. You've learned how to trust your level and your analysis and work your trade. And you've learned that your entry is more important for your position sizing, but you start with your stop for every single trade. And you're going to start to look at the stop loss as a whole different animal now that you're going to be using it correctly. I'd love to hear from you. If you enjoyed this, pop in the comments. We'll have a nice chat. And you've learned a ton. Thank you for watching. All right, trade pros, and there you have it. Now you know how to lead with your stop and how to use it the correct way. Now, it's important to know if you're a new trader or not yet profitable, this process is a guideline. And as you start to develop your own strategy, you can begin to modify it, change it, and tailor it to your liking and to your specific trading strategy. But when you lead with your stop and give more focus to the risk side of the equation, you will generate risk-adjusted returns with little heat and pressure. And you'll minimize the chances that you get stopped out and the market goes back into your favor. This is a very frustrating thing that can be avoided, and I hope you enjoyed this content. Comment in the section below with any questions or comments, and I'll interact with you directly and personally. Thank you once again for watching. Be sure to hit the like button and subscribe to our channel and hit the notifications bell because we have great content that comes out every single day. For more information on our trading courses using order flow, check out TradeProAcademy.com. I'll see you next time. Manage that risk, trade like a trade pro, and have a great day. Thank you and goodbye.